is a pathway, right? There is the whole worst, all these variables about the housing market that were really bad. Price growth was too hot. Inventory is too low. The Fed was hiking rates. Spreads were bad. All that's done. The worst is over. We got to get to that next stage. If you need ideas, I'm here. I can tell you.
Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the Fed meeting, Jerome Powell's remarks, and what it means for mortgage rates. First, I want to say thank you to our sponsor, Optimal Blue, for making this episode possible. Logan, welcome back to the podcast on this Fed Day.
Wow, this was good. This Fed meeting, man, it could have gone any 4 different ways, and there could have been a valid case for everything. So considering everything that's out there, this is as best as you could have hoped for if you're in the mortgage and real estate industry. As I'm talking to you right now, Powell's still finishing up the Q&As, and the last thing I saw is the 10-year yield just collapsed. It's about 4.25 right now. So we're getting closer to that, testing that key level. But the first thing that hit my mind when I saw the statement was they raised the unemployment rate. And we've talked about this for many, many months now. I believe the Fed kept the unemployment rate target low just in case if something happens, out there. And as soon as that kind of got off, bond yields fell, because what they're doing is they're lowering the growth for 2025, right? So they've already accounting for everything that's happening right now. So the unemployment rate target for 4.2 to 4.3 now is 4.4 to 4.5. They can raise this again for later meetings. So right there, they're telling you they're mindful of the economy. The quantitative tighten has now, I think, 25. They moved from 25 to 5 billion. Okay, so the QT is slowing down. They didn't cut it off completely. They can still do that in the future if needed to. So a lot of talk about tariffs. They raised their inflation expectations again for this year. It was going into 2% to 2025. They raised it to 2.5. Now it's 2.7 for the PCE inflation. And then the next year it drops down noticeably. So everything, just to keep things simple, because there's a lot of things going on here, this is as good as you could hope for. And hopefully he doesn't say anything crazy while we're doing this podcast.
Okay, so when they move the unemployment target like that, from your perspective, like if they say, here's the unemployment target, and then we go past that, shouldn't they say, okay, now we have to redo policy instead of just like, okay, now we're going to change the target? I know. You have to say it. People are listening.
Paper, rock, scissors. Rock is labor. Inflation is scissors. What they're telling the marketplace is, yeah, guys, unemployment rate, labor data is starting to get on our minds. So when you lower the growth forecast and you raise the unemployment rate, that means they're basically telling the markets, okay, guys, let's be aware of this, right? They could have kept it like at 4.5% at the start of the year and just give themselves. They did this, I believe, on purpose. So if the economy changes, right, then okay, let the market know. So there's so much about tariffs in this meeting, about the buying of goods going into the tariffs. How much is this? Is just a one price hit, and they're kind of telling people if it's just a one price, it's transitory. It's transitory again, and then in that context, they don't need to really hike rates in this. So that's good. That there are some people that are saying they need to hike rates, but now you got 0.5% of rate cuts into the system. If the economy gets weaker or the labor data starts to get weaker than what they're talking about, it's basically telling the 10-year yield it's okay to go a little bit lower because we'll be a little bit more aggressive. Because what we talked about before is that we already had a really big move in the 10-year yield. Like we weren't that far from my peak bottom forecast as long as the labor market stayed intact. So with everything here, that's as good as you could hope for.
Okay, as good as we can hope for. And what did you say the 10-year yield did? You just got off that call, so
it had a waterfall dive right now. I think the last I checked was 4.25. So there was a fear that they would be very, very hawkish and say, well, we're raising inflation expectations, and we're taking the rate cuts off, and if they said that, there's a case for that as well. But that didn't happen. And there was more talks about the labor market, right? I think that's the key, right? We went into this year saying labor market, unemployment rate. Unemployment rate target was low on purpose. If it moves itself up, that's a positive for the 10-year yield and rates. They're lowering, quantitative tightening is slowing down, right? So that slowdown means less treasury supply. So good. All these things, considering everything, it's a positive out there.
Okay, if you're a mortgage loan originator out there, you can say this is a positive. At least they're not, I can tell my clients they're not raising rates. They're not going to raise rates, at least that we can see right now. How low do you think they can go?
Still, the bottom end range is 5.75, and you're going to need weaker data to get you there. Now, we do these channels with the 10-year yield forecasted rates, right? And every year we have a growth slowdown scare, bond yields go down. And, we've been able to hit the corridor line twice since the end of 2023. So that's in play. If the economic data gets weaker, there you go, right? The question is, we need to have a period of time where it goes lower and stays lower. Right. So we're moving our direction toward, if we just had 1% more of rate cuts into the system, it's easier to get the 10-year yield and mortgage rates down to 6% and stay there. And why does it matter? Is purchase application data came out today. Very smidget week-to-week growth, but another 6% year-over-year growth. Quietly, and nobody else is really talking about this, the majority of the year this year has positive year-over-year purchase application data. Do you know how long it's been since I've been able to say that? Because the COVID-19 actually ruined all the purchase application data year over year. It's been a while since I've been able to say that. Now, this isn't like housing's booming. The head of the White House Economic Council went on TV and he said, housing's booming. And I was like, oh, man, I can't let him get away with that. So
he was taking that from the purchase apps data?
No. He just said it. I'm pretty sure he has no idea what the housing data is. So I had to retweet him and show him the purchase application data. And it's just like, again, like we always say, back to levels where Gangster Paradise was the number one song. No Doubt was the awesome new band, and so permits are not going anywhere. New home sales aren't going anywhere. Existing home sales are still working from the lowest levels ever. So I understand political, economic people come on TV, they embellish things. But what he could have said, what he should have said, which had the data, is that since mortgage rates have gone lower, right? A whole thing is about the housing market, right? We want the 10-year yield. We want mortgage rates to go lower. Yes. Purchase application for the majority of the year has been positive year over year. If you would have said that, he had the data to back it up. So all this is happening with mortgage rates still elevated above what the growth data is, which means that I only see data get much better when mortgage rates go from 6.64 down towards 6%. If I take the seasonality of data, now we're positive year over year. Mortgage rates haven't really broken under 6.64. If that happens, what I know the White House is thinking, housing demand picks up, and then they could market it to everyone on TV. Look, the housing market's back, right? Mortgage demand is up. Home sales are up. Americans move. Yes. And why do we know this? Because Bissett talked about, we would like to unfreeze the housing market.
Now, here you are. You have laid out a pathway for do this and get an easy win. And in the process, then you could say housing was booming, or at least the housing industry, right?
It's better than what it was last year. There's limits to what you can do. But again, I understand the concern early on was that, tariffs, inflation, deportations, tax cuts, all these things, rates are going to explode higher, 8% mortgage rates, and since that time frame, since January 14th, the 10-year yield has slowly gone down. Growth has slowed down. Labor data going out looks a little bit shaky in terms of keeping the unemployment rate at 4.1%. So they've raised their unemployment rate target. That's what the whole focus was this year going into, and we got it early, right? We got it in March. So that's a positive in that sense. So I'm just like, okay, considering everything is on the plate, this is as good as you could hope for. We're not that far. We're about 40 to 45 basis points away from the bottom end of the forecast. And if we break under 3.80, then that means, there's something, the labor data is getting really weak. Last year, the hoarder line broke because 3 of the 4 reports on jobs weeks were really big misses, right? And then the economic data started to get better, and then that come. But what Powell was talking about today, consumption, he was saying, yeah, consumption is pulling back. He's right. Like some of the consumer discretionary spending is pulling back. I know other people are looking at that as well. So there's something there that's good, that they are still focused on the economy and the labor market, where, 2 years ago, I remember one of the Fed presidents came out and said, well, even if the unemployment rate goes up and jobs are being lost, we might not cut rates. Okay, we're past that stage. And this is just a better
Thankfully.
spot. So with everything in play, that's as good as you could hope for. So I see this as a net positive. I know a lot of people are talking about the stagflation discussion. Just a hypothetical, forget about the 1970s. We're not talking about the 1970s stagflation. That was an oil shortage. Housing was booming back then. None of that is happening right now. But what you can be concerned about is, hypothetically speaking, a 3.5% PCE inflation, wage growth running at 3%, and nominal growth running at 3%. This is not the 70s stagflation, but something like that. In theory, you could actually make a case for. But hopefully, wage growth, he said, wage growth stayed solid, stabilized, okay, at a healthy level. That was positive. I'm glad that we're leaving we have to attack the labor supply. We have to attack the labor supply. Wage growth is too strong. We're going away from that. That was, you knew you had a lot of work left to attack labor if they were saying wages were too strong. Now everything is a little bit more balanced, so you could focus on the economic data.
What were the questions mostly about? Were they about tariffs?
Tariffs, right? Tariffs, is it growth? Why are you cutting rates if you believe inflation is, and again, the Fed funds rate is up here. The growth rate of inflation is here. Even their higher estimates for 20 is that they're not here yet, right? So they are still restrictive based on their policy. Doesn't matter what I think or anybody else thinks. Fed funds rate is up here. This is where it is. You know what? I became friends with Pulte on Twitter, and I'm going to do what I can to help the White House and the head of the FHFA on anything on housing. William, ask me anything you want. I'll give you the best ideas. But before somebody spiked the Fed's eggnog in 2022, there was a Federal Reserve. Those old cranky people at the Federal Reserve did have a really nice premise that if we just want the 3, 6, 12-month core PCE and the Fed funds rate to kind of match themselves to be neutral, then that's a good spot to be. That still means you've got some leeway to cut down to get to neutral. Now, everybody is wondering what neutral policy. I think neutral policy is one of these gimmicks out there. You don't know what it is because it really revolves around the economy. If the economy is weaker, then neutral policy doesn't matter. But 3.5, Fed funds rate, that could be a target that's workable. And to me, that makes it easier to get down towards 6%. And also, when you get more rate cuts in the system, the spreads can act better as well. So I could have gone any way with this. And some people say there was slightly hawkish. Some people were maybe too dovish, but whatever it is, it's a better spot than what it could have been. It could have been a very, very hawkish, dark, Darth Vader Powell out there and, just saying, oh, we're taking all the rate cuts off and we just need to wait a year or two until we see what the tariffs happen. They kind of just took a step back and said, hey, we'll see. So I'm hopefully, when I got on this podcast, it was 4.25, and that's a positive. And some of the things he was saying, I see that as a net positive compared to what could have been.
Okay, let's talk about Powell real quick, because today or last night, it's hard to say exactly when it happened, Trump basically fired 2 of the FTC commissioners. So usually you have 3 of one party, 2 of the other. He fired the 2 Democratic commissioners, which people have said if he's able to do that, if that's legal, then he could also fire Powell. Of course, we don't know. I mean, we know that he did that, but we don't know if there's going to be something filed. I think one of the commissioners is already suing over that. What's your take on Powell and his future?
So this is going to go to the courts, and the courts will decide it. I think Fed President Waller said it best. He said, the Supreme Court's going to make the decision on this. And if they say he can fire us, he can fire us. And we'll just take it from there. So for now, I've been writing this war against the White House and the Federal Reserve for mortgage rates, right? Obviously, with all the statements the White House and people in the White House have taken, they want the 10-year yield to go down and they want mortgage rates to go up. It will be interesting to see what the Supreme Court says on this. There are things that the White House, the Treasury Secretary, William Pulte, and the Fed can do working together just to get rates just a little bit lower and breathe a little bit of life into the housing market. Maybe get housing permits growing again, right? And we'll see what happens in the future. But again, we went into this starting with Steven Mnuchin saying we would like to have a cap at 4.5. I'm like, oh, nobody knew what that meant, but I'm like, oh my God, they want mortgage rates to go lower. Nobody knows this yet. If you're talking about caps already before the first week of the White House, that's a talk. So obviously that was the discussion. 10-year yield going lower, mortgage rates going, people buying homes, having sex, and then they could market it. Look what we did. We brought life back to the housing market. So we'll see what the Supreme Court says. If the Supreme Court rules that you can't do it, then it's not a subject matter. It's not a talking thing. But again, there are things, the Treasury, William Pulte, Bill, yes, things that they can do to maybe ease the mortgage rates a little bit lower. And we don't need much. We don't need much. If we're already having positive purchase application data with elevated rates, you just get it down to 6, you hold it there. Home sales are going to grow. And all the White House can market that. William Pulte could market it everywhere. It's like the movie Ghostbusters where Bill Murray tells the mayor, think about all those voters, and they kick Peck out of the door and get that guy out of there. So if you need ideas, I'm here. I could tell you. So it doesn't take much. We're not talking about 3, 4, 5. There's going to be no QE. None of that stuff is happening out there. But if we got a little bit better data with purchase apps with rates still elevated, just imagine it goes down towards 6 and just stays there. Got a couple 100,000. That's all it's going to be. But still, growth is growth. We just go with it, right? We'll take it one day, 1 week, 1 year at a time. But for now, there is a pathway, right? There is the whole worst, all these variables about the housing market that were really bad. Price growth was too hot. Inventory is too low. The Fed was hiking rates. Spreads were bad. All that's done. The worst is over. We got to get to that next stage. So hopefully that's the case. I know certain people are listening to this right now. You know where to get me. Contact me anytime, 24/7. The Chart Daddy's here to help the American people, right?
Logan
get
at HW.
A little bit more action in the housing market.
Yes, Logan at hwmedia.com. Absolutely. Or Sarah at hwmedia.com. We are both available. Logan, thank you so much.
By the way, thank you for everybody that is harassing Sarah that she does boss me around and says other stuff. So I agree with all of you. Yes, Team Logan out here. I'm very pleased about that.
I get so much crap about this. Anytime I say anything like, what was it? I told you were being too theatrical. You heard from that. And people are like, hating on me for that. I was like, literally, it's just true. You are very theatrical. You try to be theatrical.
Listen, Sarah, if you're trying to go against the Chart Daddy, okay, you're gonna make some enemies.
Apparently that's true. Oh my gosh. Logan, thanks for being on today and explaining the Fed. We'll talk to you again soon.
Pleasure.